Hello students, this is Dr. Chetna Kumawat. In today's video, we will understand investment analysis or market value ratios. These ratios are helpful to the shareholders in analyzing their present and prospective investment. With the help of these ratios, the shareholders can also compare the value of their investment with dividend, earnings, and market price, etc. These ratios also enable them in forecasting the future market price of their investments. Hence, also known as market value ratio, the following ratios fall in this category. Number 1. Earning per share, in short EPS, meaning and computation. The rate of dividend on shares depends upon the amount of profits earned by the firm. Whatever profits remains after meeting all expenses and paying preference share dividend belongs to equity shareholders. These are the profits earned on equity share capital. The earning per share EPS is calculated by dividing the profit available to equity shareholders by the number of shares issued. The profit available to the equity shareholders is represented by the net profit after taxes and preference share dividend. Thus, the formula of earning per share or EPS is profit after tax minus preference dividend divided by number of equity shares. Interpretation and significance. This is the most popular ratio as it measures the profitability of a firm from the shareholders' point of view. The higher the ratio, the better are the performance and prospects of the company, and the greater would be the market price of a company's share, or vice versa. The higher earning per share helps the company in raising additional capital without any difficulty. The comparison of this ratio with that of similar companies and industry average over a period of time is important from investment point of view. Number 2. Price earning ratio, in short PE ratio, meaning and computation. The price earning ratio expresses the relationship between the market price of a share and earning per share. In other words, it indicates how many times is the market price of a share to its earnings. Expressed as a formula, the ratio is calculated as market price divided by earning per share, or in short MPS divided by EPS, where M stands for market and E stands for earning. For example, the average market price of a company's share is Rs 40 and earning per share is Rs 10, then price earning ratio will be 4 times, which is 40 divided by 10. It means the market value of every and 1 rupee of earning is 4 times, or Rs 4. Interpretation and significance. Price earning ratio helps in the assessment of the profitability of a firm from the point of view of equity shareholders. It indicates the market opinion of the earning capacity of a share and the future prospects of the company. That is why many investors, while purchasing shares, do not consider any factor other than this. A higher price earning ratio is the indication of overvaluation of share, or vice versa. This ratio is used in determining the future market price and rate of capitalization of a share. By comparing the price earning ratio with that of similar firms or industry average, one can know whether the share is overvalued or undervalued. For example, if the EPS of X Limited is Rs 30 and the market price of its share is Rs 210 per share, the PE ratio of the company will be 7. If the PE ratio of another similar company is 8, it means that the market price of shares of X Limited should be 240, which is 8 into 30 per share. Therefore, the shares of X Limited are undervalued in the market by rupees 30 in case of the price earning ratio of similar companies is only 6. The value of shares of X Limited should have been rupees 180, which is 6 into 30, and thus the shares of the company are overvalued by rupees 30. Number 3. Dividend per share, DPS, meaning and computation. The EPS ratio represents to what extent the profits belong to the owners of a firm. But it is customary in all companies to retain a part of profits in the business and distribute only the balance as dividend among shareholders. Thus, DPS ratio represents the dividend paid to the shareholders on per share basis. The DPS ratio is calculated by dividing the dividend paid to equity shareholders by the number of equity shares issued. Expressed as formula, this ratio is dividend paid to equity shareholders divided by number of equity shares outstanding. Interpretation and significance. This ratio represents to what extent the profits have been received by the owners as dividend. An investor desiring more income would like to invest in the shares of a high dividend paying company. It should be noted that dividend per share is not a measure of profitability of a company, since retained earnings might have been utilized for payment of dividend. This increases the distributable amount without increasing the number of shares. Number 4. Dividend yield ratio, meaning and computation. This ratio is yet another profitability ratio from the standpoint of equity shareholders. The earning per share and dividend per share are determined on the basis of book value of shares, while this ratio is expressed in terms of market value per share. The dividend yield ratio expresses the relationship between the dividend per share and market value per share. Thus, the dividend yield ratio can be calculated by dividend per share divided by market price per share and multiplying it by 100, or DPS upon MPS into 100. For example, if a dividend of 40% is declared on a share of face value of rupees 10 whose market price is rupees 50, then the actual return to the investor would be only 8, which is 4 divided by 50 into 100. Interpretation and significance. This ratio shows the rate of return to shareholders in the form of dividend based on the market price of the share, that is, actual rate of dividend on his investment. The dividend yield ratio is also a popular ratio, but its adequacy can be measured only by a comparison with the ratio of similar firms or industry average. Number 5. Dividend payout ratio, DP ratio, meaning and computation. The objective of this ratio is to ascertain what percentage of net profits after tax has been distributed among shareholders in the form of cash dividend and what percentage is retained in the business. Thus, dividend payout ratio gives the percentage of earnings that are distributed through dividends and is usually expressed as a percentage. It is calculated by dividing the total dividend paid to equity shareholders by the total profits belonging to them, or by dividing the DPS by the EPS as given below. Dividend per share divided by earning per share, multiplying it by 100, or equity dividend divided by profit after tax minus preference dividend, multiplying by 100. Interpretation and significance. A dividend payout ratio of 40% indicates that 40% of the earnings have been distributed as dividends and 60% have been retained by the company. A ratio of less than 100% implies plugging back a portion of the profits into the business, while a ratio of higher than 100% indicates that distribution of a portion of the reserve as dividends. Thus, a company which distributes a lower portion of its earning in the form of dividend will be financially stronger and is likely to expand and grow faster rate. Such an action result in an increase in the reserves to capital ratio that reveals sound financial position and the capacity. A comparison of this ratio with that of similar companies and over a period of years would reflect on the adequacy or otherwise of the dividend paid to the equity shareholders. The next ratio is book value per share, meaning and computation. This ratio indicates the net worth per equity shares. It is calculated as equity capital plus reserves minus P&L account after depreciation divided by total number of equity shares. The book value is a reflection of past profits and dividend policy of the company. A high book value indicates that a company has higher resources and is a potential business candidate. A low book value indicates a liberal dividend and bonus policy or a poor track record of profitability. Book value is considered less relevant for the market price as compared to earning per shares. So this is it for the ratio analysis chapter. Thank you so much for bearing it with me.